Today, we're diving headfirst into the hidden plumbing of the global economy. We'll be breaking down a really fascinating documentary's thesis on how central bank policies and the very quiet power of private money creation are completely reshaping global wealth. If you've ever looked at booming financial headlines and then looked at your own bank account and thought, wait, what is going on here? Well, you are in exactly the right place. We're going to unpack how this entire system operates, step by step, straight through the lens of our source material. To really wrap our heads around the massive scale of this shift, we actually need to start with a surprisingly tiny number, 0.01. That is the current percentage interest rate that retirees, like a German court bailiff named Karl Heinz, who was featured in the documentary, are earning on their life savings right now. Think about it. Karl Heinz did everything right. He lived modestly, saved diligently, avoided risky investments, but today, his bank is offering him exactly 1 single cent in interest for every 100 euros he saves per year. Factoring in inflation, leaving that money in the bank is basically the same as just watching its purchasing power burn away. And honestly, a rate that incredibly low begs a fundamental question, one that economists keep coming back to throughout our source material. I mean, we all know central banks have been pumping absolute record amounts of cheap money into the global economy for years now, right? They're flooding the market with trillions of dollars and euros. But if regular savers like Karl Heinz aren't seeing a single dime of it, where exactly is it all going? Well, here is how we're going to break it all down today. We'll cover the cheap money deluge, the winners and losers, how banks create money, the corporate buyout game, and then we'll look at proposals for fixing the system. Section 1, the cheap money deluge. Let's trace where this unbelievable flood of capital actually started. The documentary traces the roots of our current system back to a few key historical pivots. First, 1971. That's when U.S. President Richard Nixon ended the gold standard, effectively detaching global currencies from any physical anchor. Then, throughout the 80s and 90s, leaders like Margaret Thatcher and Bill Clinton aggressively pushed for financial deregulation, basically opening the doors to a global financial casino. And then, boom, the 2008 financial crisis hits. To prevent a total collapse, institutions like the European Central Bank were forced to drop their base interest rates all the way down to zero. And the result of all those policies? It is absolutely staggering. When you look at the researchers' data, the contrast just blows your mind. All the physical cash in the entire world, that totals about 5 trillion euros. The real economy, the actual tangible goods and services produced globally every year, that sits around 75 trillion. But that real economy is completely swallowed up by the derivatives market, which is sitting at a massive 705 trillion euros. That towering metric is almost entirely speculative financial bets on the future. It's literally just money making money, completely detached from the real world. Moving on to Section 2, winners and losers. Let's look at the tale of two economies. So who actually benefits here? The researchers highlight a huge widening divide. On one side, everyday middle-class savers are basically getting penalized. They earn zero interest, they deal with rising rents, and their savings just evaporate in value. But on the flip side, wealthy investors have access to this incredibly cheap credit. They use it to snap up booming assets like real estate and stocks. And here's the crazy part. If a big corporate buyout goes belly up, they rarely hold personal liability. The company loses money, but their private wealth, totally fine. Former London banker Geraint Anderson describes this perfectly. He says, as a trader, he could make these reckless, strange gambles. If they paid off, he walked away with a fortune. If they tanked, incredibly, the absolute worst-case scenario was just losing his job. He calls this asymmetrical risk. The whole system basically incentivizes short-term gambling because the massive upside goes straight to the individual, while the devastating downsides get passed on to the system, or, you guessed it, the taxpayer. Building on that, economist Max Otte argues in the documentary that these prolonged, ultra-low interest rates aren't just a harmless quirk of the free market. Not at all. He calls them a symptom of a deeply sick financial system that's currently acting as a gigantic redistribution machine. It's systematically siphoning wealth away from the savings of the middle and lower classes and funneling it straight up to the very top tier of society. You can literally see this machine operating in plain sight if you look at London's real estate bubble. Global speculative capital has just flooded the city. Family homes are turning into £5 to £7 million safety deposit boxes that just sit empty. Researchers found 40,000 properties in London owned entirely by anonymous offshore shell companies. And the human cost here is real. People like Alf, who drove a local taxi for 54 years, are completely pushed out. They're forced out into the far suburbs because living in the city they actually work in is now mathematically impossible. All right, Section 3, how banks create money. Getting a handle on where this money actually comes from is super important here. A lot of people, even some of the economic students interviewed in the source material, think a bank is just a middleman. You deposit your savings, they lend that exact same money to someone else. Simple, right? Well, financial experts like Helga Pukert explain that this is actually a complete myth. The reality is something called deposit money creation. This is where private banks generate brand new electronic money pretty much out of thin air the second they approve a loan for a customer. It works exactly like this, and it's kind of wild to think about. Let's say you ask your bank for a 10,000 euro loan. The bank doesn't go searching for 10,000 euros in someone else's savings account. Nope. They just need to deposit about 1%, so literally 100 euros, as a reserve with the central bank. Once they do that, a banker basically sits at a keyboard and types 10,000 euros into your account. They generate the money electronically at the push of a button. And the kicker? They then collect real-world interest on that freshly typed-up money for themselves. Because private institutions hold this largely unchecked privilege, the documentary throws out a truly incredible stat. 90% of the entire global money supply doesn't even exist as physical coins or paper bills. It's literally just digits on a screen, numbers on a computer somewhere, created by private banks. That brings us to Section 4, the corporate buyout game, shuffling paper versus real innovation. So what are massive corporations doing with all this newly created, cheap credit? Well, they aren't exactly using it to build new factories, innovate, or raise wages. Instead, they are going on massive shopping sprees to buy out their competitors. We're talking about mega mergers fueled by almost free loans. Bayer buying Monsanto for 65 billion euros. Anheuser-Busch InBev swallowing up SAB Miller for over 100 billion. Microsoft snagging LinkedIn for 26 billion. These deals make shareholders incredibly rich, but they treat massive companies and thousands of employees like poker chips on a table. A great case study from the documentary is the traditional German cutlery brand WMF. In year one, the private equity firm KKR bought the company for 660 million euros. But get this, they only used 100 million of their own money. The other 560 million? That was incredibly cheap bank loans. Just 4 years later, they flipped the company to a French buyer for 1.6 billion euros. After paying back the bank, KKR walked away with a 940 million euro profit. That is an 800% return on their original investment. As a union rep pointed out, you absolutely cannot make that kind of profit running a normal day-to-day business. It is purely the magic of cheap debt. But here's where the deep irony of this system really kicks in. While a hedge fund can snap its fingers and borrow €500 million just to play corporate musical chairs, real innovators can't get a dime. The documentary shows an eco-startup in Munich building the Scion solar-powered car. These engineers have a tangible product that creates actual societal value. But the banks, they flat out deny them loans. Why? Because banks want established risk-free collateral before they make a bet. So, the system happily funds the reshuffling of old paper, but completely refuses to fund the future. Finally, Section 5, Fixing the System. How do the experts suggest we fix this massive imbalance? The experts from our source material lay out a few major structural reforms. First, they suggest a global tax on speculative financial transactions, basically throwing some sand in the gears of this high-speed trading merry-go-round. Second, they propose hosting international conferences for mutual state debt forgiveness to finally break this endless cycle of borrowing. And third, they argue we absolutely must force big banks to hold significantly more of their own capital against the loans they make. Put their own skin in the game so the taxpayer isn't always the one left holding the bag. We also get a look at a really fascinating grassroots movement called the Swiss Initiative. Their idea is radical, but super straightforward. They want to implement full reserve banking. This would completely strip private banks of their ability to just type money into existence. Instead, if a private bank wants to issue a loan, they'd have to actually hold 100% of that money in their vault, backed directly by the national bank. The goal here is to take the immense profit of creating money away from private shareholders and give it back to the public. So as we step back and look at this widening, frankly, dangerous gap between the high-flying financial sector and the real economy that everyday workers and innovators live in, we have to leave you with the documentary's ultimate closing thought. In a world where money literally dictates nearly every part of human life, is the creation of that money just far too important to be left solely to the banks? Definitely something we all need to be thinking about.